I hope you are all enjoying a lovely December day. I'm in the Pacific Northwest, Bellingham, Washington, and it's blustery with rain and wind, but that's how it is this time of year. Just want to say thanks for joining us today as we talk through alternative insurance structures. I think it should be a really good next hour of time. We have two insurance experts here with us today. The first individual is Greg Couchard, who's a principal at Lockton Insurance Brokers, and Greg's been in the petroleum marketing industry for about 20 years, and the last 5 years has been with Lockton Insurance Brokers. And then the second person is Bob Nizzi of Enterprise Risk Strategies, and he's been in the insurance industry his entire career and worked a lot with captives over time as well, and helping people get into captives and putting captives together too. So should have a wealth of knowledge. Really the point is to talk about alternative structures to more traditional insurance that's out there. Insurance, particularly general liability insurance, is a large operating expense for both petroleum marketers and convenience retailers. So being able to find ways to either find the set of policies that best meet your firm's need or to have it at the lowest cost can be of significant value. And what we've seen is just our industry has evolved and insurance has evolved, that there's been these rise of alternative structures that can either increase the quality, give you better coverage, or two, be at a cheaper overall cost to your company. But what those alternative structures are, it's often cloudy or murky. And so what we have Greg and Bob on the phone here today is to give us greater insight into what these alternative structures are. In terms of question and answer, I have everybody on mute here over the next hour to prevent background noise from coming up, but you'll probably have some questions. We encourage you to type those into your GoToWebinar dialog box on the right-hand side of your screen. There's a little area for asking questions. I'll be able to see those questions, and we'll ask them at the appropriate time to either Greg or Bob. So on that note, Greg, let me turn the presentation over to you and let you jump into some of these alternative insurance structures that are out there.
Good, thank you, Jed. That was a nice introduction. I appreciate it. You got through my first 2 minutes of an introduction here, so I'm Greg Couchard. I'll just go ahead and get right into it.
Glad I could beat you to the street.
You took the 5 minutes. So I'm Greg Couchard. I'm a partner in our global petroleum and convenience store group. And what we're going to do today is I've outlined 4, 5, 6 alternative insurance structures out there that we're seeing readily used today. There's more, but I picked the ones that I saw that I thought would create the best benefit for the study group members. So I spend the majority of my time in the environmental, the petroleum, convenience stores, rail risks, terminals, transportations, refineries, and the private equity space. That's kind of sort of what I do for a living. So what I've done here is I've put this table of contents together. We've got about 50 minutes left in the presentation. I'm going to go through this, and then hopefully we'll have a little bit of time for Q&A at the end, if not during the presentation. If nothing makes sense, something is I brushed through too quickly, as Jed said, please type the question in. I'd be happy to re-answer. So the first thing we're going to do is
Greg,
go over.
Greg, quick question. I don't know if you're speaking in a speakerphone or whatnot, but I'm picking up it's cutting in and out as you talk. I don't know if you can hear me clearly.
I can hear you completely clearly. I'm on my office landline, so it should be. Is it still coming choppy?
It is. Bob, is it a little choppy for you?
It is slightly choppy, Greg, yes.
All right, so let's try. You guys there? You guys there?
We are, yeah.
Okay, does that, hold on a second. All right, does it sound a little bit better?
Well,
It does.
let's move on. We'll let you know if it doesn't. Yeah.
All right, let me know if it doesn't.
Thanks, Greg.
Okay. So what we're going to do is we'll spend some time on an insurance overview, fronted programs, corridor deductible programs, integrated risk programs, traditional aggregate stop loss. Some people call these basket aggregates. We will conclude with captives, both on the group captive side and on the private insurance company model side.
That's Greg. Greg, and just want to let the audience know that we'll make these slides available to you at the close of the call as well, so you can share them with folks on your team and so forth.
So here's a bit of a simple risk finance spectrum where it kind of outlines the world of insurance from guaranteed cost on the left side, which is risk transfer, transferring all your risk to the insurance company, which comes with high premiums, low volatility of claims because the insurance company is taking the majority of the risk there, all the way to the uninsured spectrum, which is your pure self-insurance. Premiums are very low, but volatility for claims are very high because you're taking care of that yourself. And then you have programs in between there, whether it's small deductibles with aggregates, without aggregates. You have retro programs. You have large deductible programs with and without aggregates, captives, segregated cell captives, and then there's programs in between there. But I just wanted to outline this just to kind of frame up a bit of a spectrum. Fronted programs, first thing we're going to talk about. What is a front? These are fun. This is where an insurance carrier issues a policy to meet insurance requirements for contractual or statutory requirements, but the client retains most, if not all, of the risk on the back end. That's the important part. There are many ways to structure these to maximize use to meet insurance objectives, minimize costs, which is the fronting fee, that's where it gets its name, and then minimize collateral. So let's do an example here. So this is an example of a deal from the industry, the convenience store industry. A company is interested in self-insuring their storage tank liability and replacing their UST policy, which is currently covering 650 tanks. The company, the insured, pays the insurer 20% of their current policy premium, and in return, the insurer agrees to put up a new policy which would satisfy the federal financial responsibility laws. The important part is all claims then become 100% the responsibility of the insured. These are very effective on lines of coverage where your claims volatility is very low and your premiums are high. So you have a very low ratio. Another example I want to mention, I didn't put it in here, is these fronted programs are very effective in M&A transactions between parties. Like, for example, escrow funds are used readily between parties where you've got environmental claims. One party agrees to a $1 million escrow, another party agrees to a couple $1 million escrow, there's a $1 million delta. You can put a fronted program in place where you can get an insurance carrier to front that $1 million delta. You pay the carrier some dollar amount. Again, it's usually very nominal. For $1 million, you're looking at maybe 25 grand or so. But all they're basically doing is making sure that the party that is wanting the insurance gets it, the claims get paid, the insurance company then turns around and bills you just like a deductible structure. So strong balance sheets are also important for these to work effectively, but they're really good in M&A deals, and we've used them to get deals done between parties.
So, Greg, why would you, I'm just trying to think here, what are the pros and cons of this type of policy? So what would be some of the cons?
The cons are it's going to cost you money. So let's just throw a number out there. Every deal's different. So it's going to cost you, let's say, 25 grand. Where the way that the majority of the M&A deals we see are done is if you have one party requesting a $2 million escrow and another party who says it's $1 million, and everyone's got their reasons why there's a difference there, of course. That extra $1 million, if the lower party concedes, that's $1 million of escrow tied up. It's now sitting in that escrow account. These insurance policies are effective because that $1 million delta may actually never get paid. As an environmental claim gets paid out. It might or it might not. But at least the money is in your bank account, earning interest on your side. The insurance company, when the claim does happen, the insurance company will pay it, but they'll bill you back. So sometimes they tend to be a cash flow thing. An upfront cash flow, that's a positive. The downside, though, it does cost you money to buy the policy for the protection.
Mm-hmm. And so where do you typically see these kind of policies put in practice in our industry?
The example I just gave you, it's done. They are done. And those are escrow funds when it comes to environmental claims. So environmental cleanups and projects?
Yeah. So this type of policy, just so I'm clear, it's not a replacement of a traditional, it's more of a supplement. Is that right?
Yes. So it's a contractual. So in that example of the environmental side, it's a contractual policy. So technically, you, the buyer, you are still on the hook for those $1 million in claims. You have two ways to do that. The traditional way is you agree to put that money in an escrow fund, and when the claims happen, somebody just pulls that money out of the escrow fund until there's no more escrow. Okay, that's the traditional way. This way puts the insurance company on the front, allows you to keep that $1 million in your bank account instead of in an escrow fund. The insurance company then goes on the hook. They'll pay that claim first dollar up to $1 million, but they want to get paid for issuing paper, which is what they're doing. And that paper in the original example back in here, you have to have that insurance policy to satisfy the feds in a UST example because it's the law. Same with workers' comp. If it's a statutory requirement where you have to post the paper, these fronted programs become effective.
Greg, in your example here where you have the 20% with the tanks, what's the fixed cost differential there? Obviously, you being the business, the petroleum marketer is taking all the risk, but you have a significant reduction in your fixed cost, and that's really the balance between your anticipated claims and the fixed cost?
Yeah, so in this example, the policy premium was roughly about $240,000 a year in premium. So they paid the carrier, roughly about $40,000. Their claims volatility was minimal, if any. They just didn't have claims, and they had been paying historically the majority of these claims already out of their desk drawer. So and I don't exactly remember the number, but it was low. It was another $20,000 or $30,000 a year in claims. So instead of paying $250,000 in premium to an insurance company to give you coverage, you're in essence self-insuring this by paying $40,000 to a carrier, $20,000 in potential claims, $60,000. You're saving $140,000.
Yep.
You're not going to do this if your claims to premium ratio is 100%. If you're having $200,000 in claims, you're not going to do this. You just won't get approved.
Makes sense.
Good?
Thanks, Greg.
Okay.
All right.
Yeah.
Okay. There we go. Corridor deductibles. All right. So what is this? So in addition to the retained losses within a deductible, the client can also retain a limited portion of the excess losses in its primary excess layers. Sometimes those are called towers, excess towers. Excess coverage will attach above the retained layer only after the client's corridor deductible aggregate is exhausted. Premiums for the excess layer are therefore reduced by the risk-sharing approach by the client. So before I show you the example, most people take deductibles in their excess layer or in their primary layers, not their excess layers. That's another simple way of describing what these are. You can take deductibles in your excess layers. So let's do an example here of ABC Corp. Had annual auto losses of $125 grand, carrying a $100,000 deductible. Loss history there also included 2 large losses. So ABC Corp realized they didn't have much of a claims frequency in their excess layers. They were paying an enormous amount of premium in those layers. So they decided to take a second deductible of $100 grand in their excess layer. And they also added a $200,000 aggregate limit. So when you add an aggregate, you increase the premium. When you take an aggregate out, you decrease the premium. In this case, they wanted to protect themselves a little bit, so they added a bit of an aggregate limit so losses didn't exceed a real high level. Still gave them substantial premium reductions. So their approach was they wanted to share in the risk in the excess layers.
Mm-hmm. And are those fairly common in our industry, these corridor deductibles?
Common is not as common as normal insurance would be placed. Companies with strong balance sheets. Everybody has a different tolerance for risk. I would say those companies today that are guaranteed cost buyers, meaning no deductibles, these types of programs never get introduced to them because the agents or brokers realize that their risk tolerance is very, very low. Those companies that are already used to taking $50,000, $100,000, $250,000 deductibles, if these types of programs aren't being introduced to them, then there's a bit of a, a missing link. How often is it? It's not often. You might see 2 or 3 of these deals a year, depending on how many how many deals somebody sees in a year. So it's definitely not offered on every renewal for every client out there.
Bob, anything to add on these corridor deductibles from your point of view?
From an efficiency standpoint and being able to take, again, Greg had mentioned the strong financial piece to this, and I think as Greg goes through this, you'll see that all of this is about are those companies that financially can take risk on themselves, and of course the examination of that income statement and cash flow needs is a big part of all of the risk review to determine which one of or all of these would be a good risk financing option. So
that's correct. The stronger the balance sheet, the more options that are available.
Yep.
All right, let's move on to what are called integrated risk programs. So what are these? These are integrated risk solutions can take many forms. Integrated simply means there's a single block of insurance. Keyword is single. Single block of insurance spread across at least 2 lines, typically 3. An integrated program could be 100% risk transfer, which is your guaranteed cost, or have your large component of risk retention. In some instances, this is where we see, if not the majority, this is where we see clients' captives come into play to help participate in making these things a reality. So let's walk through an example here of an integrated program. So you have MNO Corp has several policies of excess coverage covering their property, D&O, cyber, employment practices liability, and workers' comp. Each layer has different attachment points. And again, what that means, is workers' comp might have an attachment point of $1 million because that's statutory. GL might have an attachment point of $2 million, so on and so forth. So the attachment points vary, and limits that vary from one another. So you have a fragmented chart. Total combined insurance spend on this deal was $1 million. By combining the multiple towers into one policy program, there can be potential cost savings of a conservative number is 5%. We've seen these things go as high as 30%. In addition to the potential cost savings, integrated programs provide the flexibility where you can write a 3-year term. That is attractive to a lot of people. Now, where do you find these products? In the global marketplace, you find these products, Bermuda and London in particular. So some clients that we'll work with, they'll buy their primary product here in the U.S., covering their primary layers, their $1 million comp, their $1 million GL, their $1 million property, so on and so forth. And then they'll look to the foreign markets for these integrated risk programs. The foreign markets like the alternative structures. Okay, move on.
In this case, Greg, the risk in this case is being shifted off of the insurance carrier and onto the marketer.
Wait, say that again, Jed?
Oh, you say the integrated program could be 100% risk transfer, and in that case, are you saying the risk is being shifted off of the insurance carrier and onto the marketer? Where's that risk being transferred?
Well, so if you're going into the, if you're staying in the guaranteed cost portion of this, then yeah, you're keeping the risk and you're shifting that off onto the insurance company. You're just going to pay more money for that strategy. If you take the risk retention piece of it, then you're taking the liability on. The takeaway in these integrated programs, it sounds simple. We see this a lot where marketers are out there and they're carrying 25, 30 different policies, okay? Every time you write a policy, you're paying profit and admin to an insurance carrier. Now, obviously, you can't get away with having only one policy cover your entire book of business. It likely doesn't happen. But on the flip side, you also don't want to have 25, 30, 70 different policies. Or let's say you don't want to be buying, in this example, 5 different excess towers covering your multiple lines of business, when you can find carriers out there that'll write you a single block of insurance to cover on top of your primary layers. Again, the takeaway is the more policies that look, act, feel similar, the more profit you're paying to the insurance company, the more money is coming out of your balance sheet and onto somebody else's. So these alternative structures are meant to create consolidation. You just have to search for these, and a lot of times they exist in Bermuda and London.
Okay, makes sense. And
okay.
Bob, anything you'd like to add on these?
Well, I think, with Greg, do you see that when you move to the integrated program, there's also more flexibility, actually more, not flexibility, but more consistency throughout that program, because all of a sudden then, instead of having maybe multiple carriers involved, you're really just dealing with, you've grouped it all together. So when it comes to claim time, there's also a lot more flexibility and a lot more ease in handling any claims.
That's absolutely a great point. Absolutely a great point. So every time you have, so again, in sticking to this example here, now there's others, but let's stick to this one, where you have multiple excess towers. That also means you have multiple excess players. If those contracts, the more contracts you have, it's no different than contract law, anything. The more contracts you have, the more likely you have for people to argue and fight. So if they are structured correctly, where they sit on top of each other, and it's called a following form policy, and they're written correctly, you can cover yourself, and come claims time, likely nobody's going to fight and claims are going to get paid. But if they're written incorrectly and on the wrong forms, you try to minimize the number of players out there, and then yes, the answer would be you minimize the volatility of claims not being paid. You have one carrier understanding your entire program.
Yeah. Good.
All right.
Sounds good. Thanks, Greg.
All right. Traditional aggregate stop-loss programs, these are sometimes called basket aggregates. So what are these? Somewhat self-explanatory, but there's a catch. This is where your underwriter provides limited coverage in the retained frequency layer that attaches at or above a chosen threshold, again, keeping a chosen threshold for multiple lines of coverage. This is also called a basket. All right, so what exactly does that mean? XYZ Corp has varying deductibles across multiple lines in their business. $5,000 on one line, $25,000 on another, $50,000 on another. That number can be anything. It could be $1,000, $5,000, $100,000. Takeaway there.
Just a second, Greg. We're hearing a little breathing into the mic, so anyway, all of us can just check to make sure it's not us.
Okay.
Thanks.
So what happens is a carrier offers a single deductible across all lines that also comes with an acceptable reduction in premium. So you're taking your 5 and your 25 and your 50 deductibles and you're picking one and finding the right carrier that'll do this. Let's call it 50 grand across all lines. Your claims volatility now is going to potentially increase if you pick the high one. If you pick the 50 grand, your claim volatility will increase on those lines where you're increasing your deductibles, of course. Carrier then offers an aggregate stop loss of 250 grand, which is the client's maximum tolerance for loss. So again, the takeaway here is when you have a program that has varying deductibles on varying lines of coverage, you want to seek to find a carrier that'll do a one deductible, understands the business across all lines. You're taking a little bit more risk, but then you can back off that risk a little bit by putting an attachment point or an aggregate. Again, they call that an aggregate stop loss. So the claims would stop at 250 grand and never pay any higher than that. That's what the client wanted, and it still came at a premium reduction.
So will all carriers do this, or do you have to find specific ones who would be willing to entertain something like this?
You have to find specific ones, and you have to be able to tell the story of the client. And again, I'll probably say it over and over till the end of this presentation. Strong balance sheets can yield negotiations that weak balance sheets cannot. So every carrier out there that's writing transportation risks, convenience stores, petroleum, supply, that kind of stuff, not every carrier will do this. So they do understand these products, absolutely. They just may or may not offer it.
Greg, you're an insurance guy, so you're probably used to folks coming into your office and telling their story. As we go into our various insurance agencies, whoever those may be, and tell our story, what are some tricks of the trade, things that we should emphasize, et cetera? You said strong balance sheet is one key that is going to help the sale job in essence. What are some other things that you'd give as advice?
Well, I think specifically in my world, understanding the risk tolerance of the client is really important. If you're heavily involved in your insurance renewals, but you give off the guaranteed costs mode of thinking, guaranteed cost is not necessarily, guaranteed cost buyers aren't the ones that are looking at these alternative structures. So if you're going into your agency and you're getting you're walking through one of your renewals and you've always just been a guaranteed cost buyer and the agent asks you, what do you want to do this year? The problem is if they just ask that simple question, you're not armed with these types of things. You're not in there talking about, well, I heard about aggregate stop loss programs. Talk to me. Let's look at that. What does that look like? Let's talk about private insurance. So the more educated you can become, the more questions you ask. That'll promote your agent to dig deep into their archive and find solutions for you. But I will say that there are lots of alternative experts out there. There's tons of them. They're all over the place. You just have to find them. And you have to find those that can access some of these products which come out of Bermuda and come out of London. So I don't know if I'm really answering your question, because there's really no, the smaller you are, the less tricks that are available to you. I mean, if you have a weak balance sheet and you're not paying a lot in premium, there's not a whole lot you can do. A lot of these structures won't work for you. The stronger the balance sheet, the more risk tolerance you have, the more entrepreneurial you are, you then promote conversation. Conversation should promote the agents to go back and dig on your behalf. It should be more than just, how do I get your rate down 2%? Because what we see is that is absolutely one part of the insurance renewal, is driving a better premium by negotiating what's already out there. Just this method
Greg,
takes a different approach.
Greg, when you say you need a certain amount of premium in order to make some of these alternative structures work, ballpark, what would be kind of a minimum amount of premium? I'm sure it varies by some of these different structures.
It does.
Any insight?
Yeah, it does. I mean, if I just threw a number out there with nothing else, I'd say $250,000. I'd say $250,000. But we've done deals smaller than that, especially on the fronted program that I talked about earlier. And that's because the balance sheet was extremely strong and the losses were extremely low. So losses and balance sheet, frankly, will drive what you can do. If you do not have any losses, I don't care how big you are or how small you are. If you have no losses, you have a strong balance sheet, you have a big story to tell. And there's a lot you can do, especially if you're entrepreneurial and you're willing to take some risk. Now, if you have a strong balance sheet and you have no losses, but you're risk adverse and you want guaranteed cost, then alternative markets aren't going to help you. They see right through that stuff. They can't help you. So really, it's hard to say, but I would say it typically starts at a number like $250,000.
That's helpful. Thanks.
All right. I will end before I hand it over to Robert. I'm going to end with captives, and we're going to talk about two things here. First one being group captives. So captives are not new. They've been a large part of the alternative market for many years. There's over 6,000 of them out there with billions in premium written. For this industry, group captives are a relatively hot topic and have been for the last 5-6 years. The other model, which is not a hot topic but should be for those that qualify, is the private insurance model. So what are these? Let's start with group captive first. So one, a group captive is just an insurance company that's providing insurance to a controlled group of multiple owners. Multiple owners can be anything from 10 companies coming together to 400 companies, but it's not thousands. The participants join in a group where they pool their premiums and share risk amongst each other. Now, this acts a little bit like the commercial insurance market today. Insurance, by definition, is pooling of risk. If you're buying insurance in the general market today, you just don't know where your risk is being pooled and with what companies. It's being pooled with hundreds of other companies. So come renewal time, two things happen. If your rates go up, it usually is because your losses are going the wrong way, or the pool that you're in is going the wrong way. Unfortunately, you can't affect that unless you go find another carrier that has a different pool, and you don't control that as the buyer. Premiums. This is where they get you. How are they calculated? They're actuarially based on your loss experience. The key is yours, not John's company down the street or some pool, your loss experience. This means your past losses determine your premiums, not state rates, X mods, or market conditions. A lot of people key in on X mods. So if you're used to buying your workers' comp today and everything's about X mod, where's the X mod? When you go into a group captive, X mod no longer matters. It's your loss experience plus the operating costs of that captive that you decide to join. And the operating expenses of a captive they just differ. There's probably 20 good captives out there, and the operation cost varies between the low end, which is about 29, the high end is close to 50. So you have to be very careful on which one you look at. The because your premium, part of your premium is how efficiently that company operates. It's very similar to a mutual fund. You just have to investigate, or a wealth management, like a wealth manager. Where is he putting your money? What's the performance been of that captive over the last 5 years, 10 years? So you do a lot of analysis to figure out where you want to go. Just joining one, just for the sake of joining one, is I try not to do that with clients. You really need to look back 5 or 10 years to see the performance. And then lastly, what do you put in a group captive? Workers' comp?
With these captives, Greg, if I hear you right, what you're saying, kind of like what you've said with the others, if you're a safe company, the captive can be more beneficial to you. If you're an unsafe company, now that you're, I guess, paying your own risk, you could find yourself in more trouble.
Yes and no. Actually, these group captives are not going to let you in unless you can prove to them that you're safe. So the common theme here today is they're going to look at your balance sheet and they're going to say, we like the balance sheet. They're going to look at your loss record. They're going to look at a lot of things. They're going to assess you and they're going to score you. So they're not going to send out Hector the inspector, but they're going to come out and they're going to do about a 4-hour survey on your business, sometimes longer, sometimes they last a day and a half, which is really great because you get these 20-page reports on your business, everything risk-related, what you're doing right and what you're doing wrong. If you can't prove to the board that runs this company, this insurance company, that you're a good risk going forward, they're not going to let you in. You just can't join. Now, on the flip side to that, if for some reason you do get in and you are actually the worst risk in the group, right? Because somebody is going to be the worst risk, somebody is going to be the best, there's going to be a bunch of people in between. The ideal scenario, if you want really, really cheap premiums compared to the commercial insurance market, you actually want to be the worst risk because you're going to benefit from all these guys that are doing great. The guys that are great don't like the guys that are really bad. So again, that's the definition of pooling. So hopefully
I want to own the worst house in the neighborhood kind of thing.
You want to own the worst house, and then over the course of about 3 years, you want to become the best. You got it. You want to paint it and fix it up, and the neighbors come over and give you flowers and do your lawn for you, whatever. Eventually, when you become the best, you have the highest market cap, and you'll make the most money. That's how it works. So the guys that look at group captives and they go, oh, man, I'm not going to save any money. Well, I'm going to tell you why. That doesn't mean you shouldn't join. What should be explained to you is that you're actually the best risk in that pool. You are the best risk. You have no losses. You have an impeccable balance sheet. But also, guess what? You don't control your own destiny. In the group captive, you get to control your own destiny. You will likely, providing you think you can continue to keep your claims down and your balance sheet net worth high, you will likely stay at the bottom, meaning the best risk, and you will have a flat renewal for a very, very, very long time. Whereas in the commercial market, you might say, okay, well, I'm in a pool. So part of my premium is because I'm a good risk, but what happens if the pool you're in 3 years goes crazy? It's a bunch of, concrete guys or whatever. Your rates go up and you don't understand why your rates go up. Well, now you should be able to say, I participated on a call. My rates could be going up, which I'm scratching my head. Why? I'm a great risk. Well, that's because your pool's doing poorly. So
what I find interesting, Greg.
What was that?
Oh, I was just going to say what I find interesting, kind of a theme that I'm hearing you say is the safer companies and those with the stronger balance sheets are more and more starting to opt into these alternative structures. And so if you are a safe company, the folks that are left in the traditional insurance market are the less safe companies who are going to have the higher premiums associated with. And, so you're going to be left with the less safe companies as opposed to being in a group of folks with the safer companies. I just find that to be strategically an interesting trend.
Correct.
That safe companies really have to look at.
Correct. And what's going to happen is when I transition the slide deck over to Bob, we're going to introduce a what I call a bridge to the self-insured world. Bob. So some of the slides that we've gone through today, when I introduce Bob and we talk about private insurance, you can now create a mechanism for those companies that may not qualify or feel comfortable for that self-insured world. Again, I'm going all the way on the other end of the spectrum. I can help, or the alternative markets become available to the riskier company with the help of what's called private insurance, and Bob will talk about that shortly. So there is a way to get there if you want to and can think 2 or 3 years strategically down the road. You don't have to be held captive, so to speak, to the general commercial marketplace if you don't want, if you're open to exploring a 3-year, 4-year, 5-year path. There's ways to get you there. So on this deck here, just concluding, again, what you're looking at in a group captive is typically workers' comp, general liability, and auto. You can look to put property and employee benefits as well in a captive. You just can't bundle all these together. So you would place property in a separate captive, employee benefits in a separate. The only ones that can be bundled are comp, GL, and auto. So lastly, I'm not going to spend a lot of time here. I'm just going to introduce it and then hand the mic over to Bob. Private insurance company model. What is this? A pure captive is a closely held insurance company controlled by its owner. Generally, companies are setting these up to enhance their current commercial structure, not get rid of it. Captives are not designed to completely get rid of commercial insurance in the pure captive world. Secondly, the one we see more often is the direct captive program. A traditional captive arrangement in which a company, or that you'll hear people call it the parent, sets up its own insurance company to insure the risk under its deductible policies. That's the key word. Set these up to insure the risks under your deductibles. That's where the volatility is, or those risks currently self-insuring. The captive issues a policy back to the parent to reimburse them for the risk under the deductible. So Bob will talk about this more, but this is the bridge that gets people over the, I'm afraid to take a larger deductible because I might have losses. The premium only went down 5%. Why would I take on another $50,000 in losses? This is that bridge. You can fund for that. And I'll briefly say, here are the program design benefits of doing this. One, you can fund for uninsured exposures. Those events that will eventually happen, you can fund for them today. You can fund for cost-prohibitive structures. Too expensive in the commercial market, you can do it through a captive. You can manuscript coverage. That's important to a lot of companies. You can offer subsidiaries that you might have deductible buy-downs. It enables them to take larger deductibles, save on premiums, but also protects them from unwanted loss. And you can use these to set up joint ventures and development projects. Lastly, the financial benefits to these. One, it's absolutely effective in lowering traditional insurance premiums. You can create up to $1.2 million annually in corporate tax deductions, and you've now changed your investing strategy because you own an insurance company, which are treated differently by the IRS. You now have, you now have pre-tax dollars to work with and invest with versus post. I'm sure there might be a lot of questions around this, but Bob,
yes,
I'm
sir.
going to hand this over to you. Jed,
okay.
Unless you have questions there, to conclude my piece, Bob's going to go a little bit more detail into the private model. Because it kind of wraps this whole conversation up in a nice little bow.
And Greg, I'm going to need your help. I had some technical difficulties here, so if you could help me with the screen, Greg, that'd be great.
You got it.
So, private insurance companies. So we work with clients across the country that are mostly privately held and are looking to take or have the culture of taking risk on themselves. You'll see the theme that Greg has outlined and what we'll discuss is just a niche of what was discussed earlier, but it's a culture of, okay, I want to take risk on myself because I have the control and the process and the procedures in place to take advantage and use my risk management dollar most efficiently. As we look, and Greg mentioned, and this is kind of a duplicate of his slide, is that captive insurance companies, and that's what we're going to talk about today. What we market as a private insurance company is just a captive, a form of a captive insurance company. It's no different than Ford's or a group captive, except for some components on how the premium is treated. And we'll talk about that moving forward. But you know, from our standpoint, we manage captives. We continue to see all sorts of captives continue to grow through the country. So the private insurance company, or moving to the next slide, Greg touched on the flexibility and the versatility of this risk financing tool. So regardless of which program you choose, you are dealing with insurance contracts. And Greg, as you know, those insurance policies, and all of you probably know, aren't 5 inches thick because they're saying, congratulations, here's everything that's covered. Okay? You know, we all know that they're full of exclusions and what is not covered by those policies. And the reason that as a business owner you're comfortable with that is because those coverages, or those exclusions, one, don't happen very often. So the insurance term, they're not high frequency. And because you're a successful company, if it did happen, you could pay it out of cash flow. So in essence, whether you know it or not, you're self-insured for all of those exclusions. All we're doing is saying, hey, maybe it makes sense to put that into an insurance model because, one, as the slide says, you're going to, and Greg mentioned, you're going to get coverages you don't currently have. It's sleep insurance. It is coverages to support your primary insurance program. And it's a very flexible and hopefully profitable risk financing tool that does create a business expense. But just like any captive, if you manage your losses, you own the underwriting profit, and you are involved in investing that underwriting profit, and you own the investment return on that. So, and most importantly, as you continue to grow in your business, this program is completely dynamic. It's just like any other company you own. As you grow, your insurance company can grow. So who should consider it? So we've talked a lot about, and on the next slide we say, okay, who should own a private insurance company? So in our experience, one, we need significant uninsured risk. And really that goes across all industries. We're pretty much industry agnostic as long as the company is large enough and we can find that uninsured risk that we want to put into this insurance program. Certainly petroleum marketing, convenience stores, significant uninsured risk in that industry. Again, most of our clients, very closely held organization, entrepreneurs. We have clients that are as small as $5 million in gross revenue, as large as $800 million in gross revenue. I would say our kind of the bell curve of that would be 20 million in gross revenue all the way up to about 275 million. That's where most of our clients would, although it's a large swath, that's where most of them would land. But most importantly, they have strong cash flow, strong business cash flow. And that's an element with your cash flow that you are self-insuring your particular business with that cash flow for those exclusions that we touched upon. So what kind of, we always get the question when we start doing this is, you know, okay, give me examples of kind of the stuff I don't have covered in my current program, and we'll touch on that in slide 22. So if we move to the next slide, it talks about some example coverage descriptions. First, as the one on top is a government action or protection policy. As we all know, there's no insurance policy out there that allows or covers a form of government coming in and causing an expense or a revenue loss. Okay, we have some examples, whether it's state or federal government, whether, you know, as an example in the construction industry, OSHA fines. Those aren't covered by a primary insurance program. The other part of that is product and services reimbursement. So there's significant, the expenses associated with inspection, repair, replacement, removal or disposal. those aren't necessarily, they're a product of your work, and those aren't covered by a primary insurance program. A number of our policies support the primary business interruption program. So in this example, we have another example of, we have a package of supply chain interruption, and that could be, let's say you might have a critical customer or a critical employee or maybe a critical supplier that if that supply chain was interrupted, it would cause you additional expense or loss of revenue to replace it. And that policy is intended to cover that. And then we just really moved into supporting some of the primary health care. A number of you may or may not be partially self-insured on your medical benefits program for your employees, but to Greg's earlier comment on deductible reimbursement program, we applied the concept from property and casualty of funding your deductible to the healthcare, that your self-insured program. So we have a policy for that also. So as you can see, one, do all of these happen a lot? No, but if they did, you'd have a significant impact on your income statement, and that's what we're trying to protect. It's sleep insurance. So as we move to the next slide, I'll talk about some case studies on how we've helped other industries or other clients. We do have several clients that are in the petroleum marketing industry, but here's some examples we used from a case study perspective. We recently had an East Coast real estate developer that had to carry environmental liability, and in that policy, because of contractual agreements with the government, they could only find cover, and Greg, you can attest to this. Sometimes a carrier will say, yeah, I'll be happy to write your business, but you're going to have to take a $250,000, $500,000 deductible. And of course, they need that to meet those contractual agreements. They need that paper, similar to the fronted program that Greg was talking about earlier. So what we did is create a deductible reimbursement captive or policy as part of their program, where that allows them to take that risk on the standard policy, in this case the $250,000 deductible, but then actuarially determine how to pre-fund for those losses inside the deductible layer. Why they like to do that is because, one, pre-funding via an insurance premium is going to create that tax deduction, the business, so they accelerate the deduction as opposed to have the deductible paid out over perhaps a number of years. They get to take it in the policy period that it's associated with, so it just accelerates that. And if they don't spend it, those premiums are building up as underwriting profit in their captive. So because they don't have a lot of these losses of which they have to apply the deductible, but they get to take that business expense and have that build up in the captive as underwriting profit and control that investment of the captive. Our next example.
Bob, just so I'm clear, because it's a captive, i.e. insurance company, the profit, should there be any, is not subject to income tax. Is that what you're saying?
Well, it's interesting that you say that. What happens is, and we're going to touch on this a little bit, it depends on quite frankly, the structure of the captive and the premium volume. As we talked earlier, Greg mentioned in a slide, the premium that is written from the business and flows eventually into the captive owned by the business owner, as long as the premiums are under $1.2 million per year, so this is an annual premium, those are not deemed taxable income to that insurance company. Okay? Only the realized investment income on that asset is taxable income to the captive. So in essence, up to, if you had no losses, you could have up to $1.2 million of underwriting profit per year building on a tax-deferred basis in your captive. Does that make sense, Jed?
Yeah, that does.
Good.
Yeah, so it's one way.
Appreciate your question.
One way to move money from one company into another, and at least for the time, not pay taxes. I'm sure at some point in time you'd have to. Well, if you didn't have any events, which would be fortunate, at some point in time there'd be a reconciliation.
Yeah, so as good point. So what we're doing is say, your left pocket is your business, your petroleum marketing business, and your right pocket is your insurance company. We're simply moving up to $1.2 million. Again, that's actuarially determined from your business, which reduces the tax liability of that business, over to your insurance company or your other pocket. And as long as it's under $1.2 million, it's going to build on a tax-deferred basis in that pocket. Okay. Another example here, and I see here we're getting close to time, so Jed, just let me know what I need to do from that perspective. Why don't we do this? Let's talk a little bit about more of the model, maybe, Greg, as opposed to some of these.
Skip through the examples?
Yeah, what do you think about that idea, and just kind of get to it, because from a time, I want to be sensitive to everyone's time here. Oil and gas, and we can share these with you when you see it. So who can own that insurance company, and that's an important piece. Oftentimes we have where individuals, as long as they're over the age of 21, owning the captive or the insurance company. What I want to get across with this slide is the ownership of the insured entity or your business does not have to be the same ownership of that insurance company or your private insurance company. So there's significant flexibility on how you can own that insurance company depending on how you want to use those underwriting profits in the future. So very flexible program. Here's the idea of it, and we talked about a little bit with Jed's question, is we're going to work with you, find those unique risks that you currently don't have coverage in your primary program. We're going to then take those risks and get an actuarially determined premium. That premium, then you're going to write to our insurance company, which is ERS Insurance. And just like the group captive, which has a pooling model, that's our pooling model. And for that, your business is going to get those insurance policies we all agreed upon. Your captive, or the white box, the PIC, is then going to reinsure ERS Insurance. And that's going to generate premium from the orange box to the white box. And again, as long as that premium is under $1.2 million, the insurance company or the PIC can take the 831B election that says, do not tax my premium income as income to my captive. And then ultimately, that's where you would work with your advisor, your wealth advisor, to manage the underwriting profit as you see fit in that private insurance company. What is significant is when you decide to pull that cash out, let's say either you want to issue a qualified dividend to the owner, or 7 years down the road you decide, hey, I want out of the insurance company business, I want to shut down my captive, those dollars or those assets will come out at long-term capital gains out of the insurance company instead of at ordinary income rates. So it's a very efficient use of risk management dollars. And as those assets build up in your PIC, you can use those assets to support even more of your primary insurance program. This is just what we call our premium to assets. So we compare using after-tax dollars in your business to self-insure, or using a captive to insure for risks. And in this particular example, and we kind of try to do this for everybody as we go through the underwriting process or viability analysis, in this example we assume that premiums are $1.2 million. We assume, as you can see, there's some smaller claims. We also assume there's some large claims. One claims 250, one 750. So we are assuming we're using our insurance company as we need through this 10-year snapshot. And in the end of the day, you'll see the benefit here. After taxes, after fees, after all the expenses of associating with running your private insurance company or your captive, and you get out in 10 years, you have $8 million of long-term capital gains that goes to the owner of the captive, versus taking after-tax dollars, investing them in the same way, and then liquidating in 10 years, you have about 6.3. So you've increased your portfolio or your assets by almost 30% in 10 years by self-insuring using a private insurance company. And that's with claims and fees and everything. That's a net benefit analysis. So from a long-term perspective, it's a very flexible risk financing tool that will allow you to support your primary insurance program and ultimately build assets up in an insurance company. Greg, any thoughts or anything that I missed there?
No, I think you actually, I was going to jump in and say one thing, but you touched on it on the end. You know, this is that bridge, you know, if we say it here, this is that bridge I was talking about where how do I, you know, clients will ask, how do I decrease my insurance premium if I'm not interested in taking deductibles? Well, this is a mechanism, one of many, but one mechanism and a very strong, advantageous mechanism for looking at ways of taking larger deductibles, looking at fronted programs, looking at aggregate programs, but then insuring that potential risk with this insurance company model so that you can get that deferred tax deduction today, ordinary income, and if claims are never paid, you know, that's the best case scenario. If claims never are paid over that 10-year period of time, you've got a pretty spectacular return on your investment.
Absolutely, and I think from the last slide, Greg, what is unique about the captive industry is that we have the rules and the guidelines to follow and how to set up your captive. So the last slide is really just looking at, if I was going to look at a private insurance company model, what's important about the model that I'm evaluating. And if you look at recent captive decisions with the IRS, regardless of the size of captive, here are the 4 main points that you should be looking at and asking about, which is 1, why am I setting up an insurance company? What's my business purpose? And that's why it's important to look at your primary insurance program and manuscript policies that are specific to the second point, real insurance risks. So you want to make sure that you have a business purpose and an insurance risk, and then ultimately risk transfer. So you're transferring risk out of your business into an entity you don't own, and risk distribution, which is basically the concept that Greg had mentioned earlier, which is pooling, which is insurance in general. Insurance is about, hey, rather than taking one big loss, I'll help people pay with a smaller payment, and it's pooling risk together. So those are the key components as you look at those models, or if you go out and look at a model for that. And then in 2002, the IRS gave us 3 revenue rulings on regardless of what your captive is or the size of your captive, how to operate that and meet and be determined in a safe harbor or a real captive. So we've got really good black and white guidelines to follow. Right now, the companies or this model's under scrutiny. If you go Google it, you're going to find that it's under scrutiny by the IRS because not everyone is following these basic insurance principles. So that's why I wanted to bring this slide up. Those are important pieces as you examine the business strategy.
All right. Well, thank you, Bob and Greg,
sure,
for sharing. I think as you got to that business purpose of setting one of these insurance companies up, I thought your advice on looking at your current insurance policy and all those things that are excluded and starting there. I know, like the infamous pollution exclusion that's in all these current insurance contracts that are real risk to petroleum marketers and convenience retailers. You know, maybe something that could be thrown into the insurance company in a way to protect yourself against it in a tax advantaged way.
Absolutely.
Well, everybody, thank you so much for participating in the call. I will send out here in the coming days this slide deck. It has Bob's contact information on it and also Greg's. And I know both of them would welcome any questions you have. I know we talked about several complex things in a short amount of time. And, you know, people rightfully would have more questions about it, and they'll be happy to follow up with you.
Sure.
Well, with that,
Great.
good talking with each of you. Thank you, Greg, Bob, and hope you all
absolutely.
have a great Christmas coming up and in a few weeks preparing for it with the shopping and everything.
Right.
Well,
Yep.
Goodbye.
All right,
Thanks for the time.
All right.